never saw anybody talk about the institutional price levels, and they seem very simple to me. I can see like the numbers, 800, 200, 500, but I don't see the use so much of the institutional price levels. So I watched your video twice, um, but what's the actual use of them? Is it more like an extra confluence, like a guideline? Because with an order block, sometimes you can see very immediate reactions from order blocks, for example, or breakers. But these institutional price levels to me feel more like you can draw them like on these levels, but yeah, I don't really see price being bound by them. It's more like you can draw them wherever you want. And then when price fits, it fits. So it feels a bit weird to me.
Okay, well, it's good that you brought that up, and I believe what you're saying is true just by looking at the chart. But whether you may or may not know, the entire forex market is run off of an algorithm, and this
Mhm.
algorithm is called the interbank price delivery algorithm. And this RPDA is basically driven by these institutional price levels. So, like we have the round number, the 200, the 500, the 800, those are where the algorithm puts orders and maintains price, either keeps it above or pushes it lower. And when price gets to these levels, we will expect reaction either further to the upside or further to the downside. So, like you say, let's just look at EU here. So, the high of this week here. So, if we put an 800 institutional price level over here, you can see that the price did not touch the institutional price level of 800. Okay, and if we put our next one
Mhm.
over here of 500, so you can think of institutional price levels as support and resistance. So instead of choosing the wicks or the bodies of high and low moves in the market, so like a medium term high or a medium term low or a long term high or a long term low, you can use these price levels as what the retail calls it as support and resistance or supply and demand zones. And the reason for this is because of the algorithm that exists in the FX market. And the algorithm is what controls price. It delivers price to us as the people who use brokers, because obviously the institutions and the market makers get price delivered to them directly. So they don't use whatever FBS or Hot Forex or XM Broker. They do immediate transfers across borders, across governments, countries, whatever, directly. They transact directly. We have to use an intermediary, which is our broker, and our broker gives us the price through a liquidity provider. And a liquidity provider is basically the banks as we know it. So, Bank of America, Bank of England, Bank of Japan, Bank of Australia, these are the banks that give and distribute price amongst the liquidity providers, which in turn gives us the price we are delivered to. So that is why there is spread in the market. That is why there is different factors of different price for different brokers. So maybe your candlesticks on your chart for your broker will be different. They will appear different. And your high for the week. So my broker's high for this week is 1.13716. Okay. So if
Mhm.
you go look on your broker, your high may differ to that by whether it be 5 pips, 10 pips, 2 pips. The price is not consistent, whereas the IPL is consistent
Yeah.
throughout. So the
Yeah.
IPL is regardless of your broker, regardless of what country you're in, the IPL is consistent because the IPL never changes. It is always consistent. So the price levels are always the same. And when price gets to these levels, your broker, my broker, Henry's broker down the street, Tom's broker up the street, all giving different price, different highs, different candlestick formations. The IPL is consistent, and that is what makes the IPL so important, is because it is consistent and because the algorithm that runs and gives us the price we see is so important. So what essentially I'm saying is, when we are looking at anything, whether it's a currency pair, a commodity, an index, there's two things we are trading. We are trading time at the bottom here. That is why there is dates and things. That is the time. And we are trading price. So those are the two factors in anything when we trade, is time and price. And knowing an IPL, an institutional price level, that is specifically set and always consistent throughout, that never changes, is more important than knowing what the exact pip of the high of the week was, because it's irrelevant what the high of the week was based on your broker, my broker, or anyone else's broker. It's irrelevant. So that's what makes IPLs so special. And we can see here, although this Euro USD did not touch the 800, we can see that price blasted through here, through our 500 IPL, and did not maintain the 500 IPL. So the algorithm protected this 800 IPL level over here. So if we saw that price was trading inside the 500 and the 800 for the rest of the week, and maybe consolidating, and there was some accumulation, and then the market closed, we could expect that price will just bounce off of the 500. But the fact that the algorithm protected the 800, pushed price down, and still went lower than the 500 IPL, now it has more work to do to get price back up into those levels. So we can see here that if we add our next IPL, which is the 200 over here, you can see how price reacts. And you can go look and read previous chart data of pretty much all of the, whatever you were looking at. If you add these IPL levels, you will see reactionary areas based on the IPL. And the reason why I say the IPL is so important is that not only can you use it on higher time frames, you can also use it on lower time frames. So if we go look here, and let's say we go down to the 15-minute chart here, we can see that on the 15-minute chart, that price perfectly traded into our 200 IPL, and the algorithm protected the 200 IPL level here. Okay, so if we go and add our next IPL over here, which is the big figure or round number, and we can see here that price basically traded up into the IPL over here. The IPL rejected price and rallied back up. Where did it rally into? IPL levels. And although you may not see what I see on the chart, the more you go and look at previous chart data and add your IPLs, you will see what I'm talking about. Does that answer your question as to why IPLs would potentially be of a factor of importance to you?
Partially. It's still a little bit abstract, but let me just let it sink in. Like you said, like just add them to the chart, let the data sink in, and I will come back to you if I still don't understand.
Okay, sure. So I'm not saying now go only trade RPL levels, you know. So what I'm saying is, obviously an RPL is a concept and a reactionary area, just like an order block or a fair value gap or a liquidity void or whatever we're looking at. And the IPL just gives us extra confluence to look for a reason to want to buy or sell into the market. So as an additional confluence, this was a trade that I personally took on, I think it was Thursday, where this gap needed to be closed over here. So if we look at the top here, and this price traced down, or sorry, went down and retraced back up over here. And when it did that, obviously there's multiple confluence being an order block over here, as well as a fair value gap, and about 50% of that fair value gap was closed. But there's also a institutional price level here of 500. So we can see that the price failed to even wick through, never mind close the candle bodies above that institutional price level. So this is a 1 hour chart. And obviously, if we look at a 4 hour chart, we can see the same thing, but obviously just less candles. So when we see institutional price level being respected, or maybe an order block being formed around those levels, we can say that if you were to use it as a retail uh, theory, that could be resistance for us. So I don't teach support and resistance or supply and demand.
No, I don't know what it
Basically,
means either, to be honest.
yeah, it's
I never watched
irrelevant.
retail.
Exactly, you don't know, it's irrelevant. But basically, this is a action area of where we would want to sell price to. So just by looking at this and say we pull a fibs for a sell over here, now we not only have a fibs over here that we've pulled, we also have an order block formed. So if we look on the 4 hour, there was an order block formed. On the 1 hour, there is an order block formed over here. We have an IPL, we have an FEG. So, and that's multiple confluences for us looking to sell. And that was a beautiful trade. I think I caught about 90 pips on that one. And I think there was a couple of others in the group also that caught this exact same trade with the exact same setup. So there is just confluence being added to your trade if you have IPLs on your chart. And
All right.
also another reason is IPLs can be used for scalping. That is something I teach separate to this YouTube channel. I have a couple of people I'm teaching how to sculpt with the IPLs, and it's quite profitable and it's very easy to learn. So the IPLs can be used on lower time frames as well as higher time frames, and they can be traded by themselves, and they can be used with everything else that's shown to build up a very good trade for yourself. I personally don't take trades unless I can see that there's at least 5 confirmations for me wanting to buy or sell, and then I execute or have a sell limit or buy limit set at those zones. So that's a very long answer for one question. But as time goes on, I'm sure you'll see the benefits of having an RPL. If you don't, well, then you don't have to add it to the chart. But maybe you will come to the dark side.
All right, great answer. And then to add to it, I haven't watched your Fibonacci video. Why do you add it to the body of the candle instead of the wick?
Okay, so if we look at a daily chart, right, and I think it is, let's look at GBP pair here, and let's look at a high time frame here. So if we are looking at a higher time frame, okay, now obviously on a high time frame, these wicks over here represent data. So if we go down to a lower time frame, and we just zoom out a bit here, we can see that those wicks on the daily have quite a bit of price action inside of those wicks. So although it's a wick, it has price action, okay? Now, as we go down to a lower time frame, the wicks are not where the majority of price action occurs, because as I said with the IPLs, the brokers' prices of whatever we're trading are all different. So your wicks will be different to my wicks because your broker's price and your spread and everything is different. So we use the bodies because on lower time frames, the real volume of data occurs inside of where the body is and not where inside the wick is, okay? But obviously the higher time frame you go, you need to use the bodies. as well as the wicks on the higher time frames. But if we go to 4-hour, well, then we can just forget the wicks, because sometimes you'll just have a lot of wicking into price levels. And it's the same if we are looking for a setup over here. And there's often times where you pull a Fibbs and you see price wicking through the 79%, and price still closes below than the 79%. So that's fine. Even if price wicks through, this was a question I previously answered, even if it wicks through the 100% and breaks the previous high over here like this, as an example, we can still consider that if the bodies close within our sweet spot area, that this is still a sell, because it is a premium area to sell, because remember, we sell at premium and we buy at discount. So if the bodies still are inside of our sweet spot, the trade is still valid. So, and that's on a 4-hour or 1-hour, 30-minute, 15-minute body to body, and daily, weekly, monthly, you can use the wicks as well to include the volume of price that occurred inside the higher time frames.
All right. And so when price is nearing a level with lots of confluence where you expect a reaction to form, you wait for the reaction to happen, right? And then you enter on a retrace, for example, but you always wait for the reaction to the level to happen.
So this was a previous trade. Maybe this will help with your answer here. So are you talking about a Fibbs specifically?
No, just in general. In general, taking a trade, entering your trade, you marked out certain levels, order blocks, institutional price levels, yada, yada, yada. You expect at that point when price hits there in that area, you expect a reaction. Do you
Correct, yes,
place your limit, for example, in advance? Or do you wait for a reaction to the level to confirm your bias or whatever, and then enter on a retrace?
Okay, so if you have a directional bias on whatever you're trading, okay? So as an example, I had a sell limit set at this area over here, okay? So on that area of price, I had a sell limit set over there, and my directional bias for when price cleared these highs over here. So I obviously had a pre-configured mindset that once price had raided these highs over here, okay, because this was a liquidity pool, so there was obviously sells, buy stops and stop losses sitting above here, and when price raided through here, then I was expecting a sell. Okay, now I didn't immediately sell from over here. I waited for price to go down and then show me that it wants to go down again by coming and retracing into a additional sell zone. So like you said, you like to trade fair value gaps or liquidity voids. Now there's a reason that those are so special. You can think of it like this. So obviously, when a liquidity void or a fair value gap is formed, there is a large number of orders that were placed to whatever this particular scenario to the downside, right? So when price gets back into where the liquidity void or the fair value gap was, price will drop again because there is a lot of orders there. The simple fact that price retraces just gives institutions, traders, or whoever we're talking about, banks, them another opportunity to get into the trade. So when we are looking for a trade setup specifically, say like this, we want to see a story of price. So when price was going down here, we didn't just jump into the market, okay? We saw that there was a gap formed over here between these levels. So when that gap was formed and price was moving down over here, we saw that a 4-hour order block was formed, a 1-hour order block was formed, a fair value gap was formed. We pulled a bearish fibs because our directional bias is bearish because they had raided the liquidity. And now when price came into our selling zone, we sold. So it's up to you as the trader to decide, do you want to have a limit set or do you want to execute? Sometimes limits can work in your favor and sometimes they don't. It depends on, do you have a day job? Are you sitting in front of the PC being able to trade? If you can trade all day, then there's no reason to set a limit other than maybe to remind you. Say you set a 0.01 limit, and that is just to remind you that you've been entered into the trade and the price has come into your selling zone, and then you maybe want to take your actual lot size once you see the reaction that you see or want to see, and then you add your one lot or whatever you're trading with that you actually want to see. So often,
Why is that?
why is what?
Because I can sit behind the computer all day. I'm very lucky in that sense. But I always place limit orders. I just mark out my setup, and I'm still very new, of course, but I just mark out my setup. I like where I want to enter, where my stop loss is, and then just wait for price to reach there. And why should I use a market execution? Because then I always either get in too late or too early.
Perfect.
That's a little bit of a problem.
If that's the way you trade, it's very similar to how I trade. Then by all means go for it. Some people don't like to sell limit or buy limit, and that's I guess their personal preference. But I swear by limits for buys and sells. Other people ask me why I don't use buy stops or sell stops. Well, it's because I don't use them. I don't see the purpose in them. So if that works for you and that's how you want to trade, then I can give you confidence to say that it works. If you've identified a good setup and the trade goes in your favor, well, then it's most likely a good call that about an 80% certainty that you will have a sniper entry. So this was exactly a sniper entry because it was a sell limit, and there was a couple of other people in the group also that had a sell limit set at this zone. So oftentimes you'll be taken into trades that maybe you forgot you had put a sell limit on, and then you get taken in and you look at your account again and it's running 50 pips, So sell limit, buy limit's great, and it's good for whether it's fair value gaps, order blocks, or whatever your markup on the chart is created or whatever you see. So there's continue using it. There's nothing wrong with buys or sell limits.
Okay, cool. Can I ask another question, or should we offer
No,
other
you
people
can
sometimes?
you ask one more question, no problem.
Okay, so in this trade, you just marked out this was a sniper entry, you said. So you would have entered like on halfway of the fair value gap, and your stop loss would have been on the high, like on the peak high.
Yes,
Or where?
so what I
Or,
normally suggest is you include your broker spread. So say for instance you wanted to enter at say 490 the price, maybe just pull it back by 3 or 4 pips because price may not reach it exactly, like I say, because broker price and spread and everything. So you incorporate that into your trade and you have your sell limit or buy limit, whatever it is, and you wait and you put it at the 50% because they like to sometimes use only 50%, sometimes even less than 50%. Sometimes they'll use 10%, or sometimes they'll even close the entire gap. So we can see here that this entire gap over here on Friday before the market close was fully used. This gap over here was fully used. So what could potentially happen on EU if the bearish bias still continues is that to close this fair value gap that exists at the top here, we could see that the price may come in there and we have reaction off that zone. But because we trade price action, I don't like to say, EU is going to go 1,000 pips next week. I just trade price action, and, sometimes you'll get a swing, sometimes you'll catch 40, 80 pips. And to me, it's not about catching 1,000 pips a week or 10,000 pips a week. It's the value of your pip, because, you know, everyone's using 0.10, 1 lot, 2 lot, whatever they're using. And if you catch 40 pips a week, that could be $4,000 or $400, depending on your lot size, you know. So I'm not also telling people now to go and trade with a 1 lot size with a $50 account, but I'm saying that if your risk reward ratio is good, then your account will grow with the trades that we make. So a lot of people have found that to be quite profitable to them. And yeah, so fair value gaps, they can be used as price targets for where price can go to or bounce from. So it's very likely that either can happen. So we can actually see here, there was a reason for price coming to this area over here. When price came to this wick over here, we can see that it actually closed 50% at the bottom over here of this fair value gap. And then price rallied from that position. So price isn't random. There's always a reason for where price goes to, whether it's for news or you know, elections or whatever the case is. People say, oh, there's technical, there's fundamental. I don't believe in that. I believe in looking at the charts, seeing the price action, and trading in line with how the market makers trade, because the market makers are the ones who run the market. We are at their mercy. So we can only do our best to try and see what they see, with obviously a certain degree of error.
Yep. Okay, thanks.
Anyone else got any questions?
Hi, Darren.
Yes, hello.
So my question is about just what you spoke about now, saying, you know, price might go up and close that fair value gap and then drop down. So my question is, would you encourage someone to take the trade, the first one where you actually go up to close that fair value gap? I'm asking because I always thought that, you know, we trade in line with the order flow, and looking at the daily, I think the order flow is bearish.
Okay, that's a good point. So the order flow strategy is itself a strategy, okay? So you can come and sit on the charts and you don't have to trade the order flow at all. You can literally sit at the chart and just trade order blocks or just trade fair value gaps. You can use everything I've shown you as confluence or a concept for a reason to take a trade. You don't have to follow the order flow. The order flow just allows us as the retail people to see what is happening with a high degree of probability of where price is going to, based on the flow of orders that are on the chart you are looking at. So like you say, that the order flow on EU is bearish, and the reason why I think you say that is because there is a order block over here that was traded through, and we can see that price tried to come in to test it. So you are right, and the order flow can be used, but you can also trade just fair value gaps, just order blocks, or whatever you want to trade. It is up to you entirely of how and what I show you as to what you want to trade as. Maybe you want to scalp, maybe you want to swing, maybe you want to intraday. The order flow just helps you, and the order flow works because you can use it on the daily, the weekly, the 4-hour, the 1 hour. Obviously, the lower time frame you go, the less stable price becomes, and the more incorrect and inconsistent price action you will see. So the 4-hour is generally the best time frame to trade the order flow on. And your question was, would I advise someone to take a trade up into the gap when to close the gap? So my answer to that question is you will need to wait for the London Open on, let me just put the London Open over here. So this would be the London Open on Monday, when the London Open comes, the red line indicates the London Open, the blue line indicates the New York Open. So the blue or the red line for Monday will generate which direction price is willing to go. So we can see that the liquidity over here for yesterday's high, which would be Friday, is very high up. So they took out the previous day's low rather than oh, sorry about that, guys. So they took out the previous day's low when opposed to taking out the previous day's high. So it is very likely that they will continue to take the lows of previous days out, obviously creating a bearish market structure for us where they take and create lower lows instead of making higher highs. So like I previously said on the call from the last weekend, that if we look on the daily chart of Euro USD, we can see the amount of order blocks, the bearish order blocks that were accumulating orders. Okay, so we can also see though that price has rallied. Okay, and this order block at the bottom on EU was created, and price rallied from this position. Price rallied down and created this order block, this bullish order block over here, and price rallied, and you can see it rallied off of that order block again and again and again. So we can see again on Friday that price rallied off of this order block here again on Friday. So this is a strong order block, this was a strong order block, and price has not broken this order block. So technically, if you look at the daily chart, EU is still bullish, even though they are accumulating orders here. So this large move to the downside, okay, has not been traded through. So when a pair ranges and accumulates like this, I generally do not like to trade pairs when they do this. But if we look on a lower time frame, it cleans up the chart for us so that we do not see so much noise, and it makes it easier for us to trade. So we can see that price could potentially go up into the fair value gap and then rally down. So you need to wait for the London Open on Monday to give you a reason to want to buy. Okay, so something like maybe this order block at the bottom over here, where price bounced off of this order block. So price bounced off of this order block, which is a 1 hour order block, and we have a below a daily order block. So if you see price coming into this zone on Monday and rallying from this zone, well, it's very likely that price will just continue to rally, and then we might only see a drop into this zone over here for our fair value gap on EU. So you can trade into a fair value gap and use it as a target level for price to go to, if that is how you want to trade. But you would also use confirmation to take trades why you want to buy or why you want to sell. So if you are wanting to take the trade into that fair value gap, give yourself reasons and convince yourself why do you want to buy and what will be the reason to buy at the zone you're buying at. Okay, so if we look at the 4 hour, we can see that price is making higher highs. Okay, so you can see here it's making higher highs, and it only raided the liquidity above and below, and now it is trading inside of a range. So we need to see price close above our previous high or below our previous low to make high highs or high lows. So we can see a BMS, which is a break of market structure. So hopefully this answers your question, and we will wait for London Open to see if price is willing to continue the uptrend. So these fair value gaps on a lower time frame of 1 hour have been closed. this fair value gap was partially closed, this fair value gap was closed completely, and price could bounce potentially from this 1 hour order block over here and rally up, or price can respect the order block, the bearish order block that was created over here, and instead of going up, just continue down and forget about that fair value gap. Because remember, fair value gaps, liquidity voids don't have to be filled immediately. So we know this because if we look at USD CAD, fair value gaps still have not been filled, or liquidity voids have not been filled. They get filled eventually. They can take weeks, months, days, whatever. They will eventually fill, and obviously they are a reason to looking into taking a trade for with the upside or the downside. This particular trade was something I mentioned on last week Saturday, where USD CAD should come into this zone and then we buy, and we saw a similar reaction, but we didn't quite get to the 50% of this fair value gap sitting over here. This call is going to run out right now, so I'll make another one and you can all join. I'm just going to copy and paste the text that's in the chat group and move it on to the next Zoom. I'll send the Zoom link shortly into the chat group of, and then take more questions afterwards. Sorry for the short time. I'll send the link shortly. 1 second.